why are market participants usually more focused on the 10-year yields compared to that of the 2-year? It's important to note that it's not necessarily that the 10s is seen as more important than the 2s or the 2 is seen as less important than the 10s, because each of them tells us something very important about what the bond market is expecting for different time horizons. But given that both of these two yields are driven and also used differently, it does mean that there's usually more attention on the long end, like the 10s compared to that of the 2. So just for reference sake, on this chart, we have the Fed funds rate in yellow, basically moving up as the Fed hiked rates, moving down as the Fed cut rates, staying flat as they kept rates unchanged. In the light blue, we've got the US 10-year, US 2-year yield. In dark blue, we've got the US 10-year yield. In purple, we've got the 10s and 2s spread. And then in green, we've got oil prices, just so that you know exactly which one I'm referring to when we talk about these assets. So you rightly mentioned in your question that the front end, like the 2-year yield, that normally tracks interest rate expectations. And that means that there should be a lot of attention on them. But it's also important to keep the role of 10s in mind here. And 10s is usually driven by the medium-term growth and inflation expectations for the market. So if interest rates are expected to rise in the short term, you would expect to see upside in 2-year yields like we've been seeing recently. But if that rise in market interest rate expectations is expected to potentially negatively impact the economy in the medium term, or if the market just foresees a possible economic slowdown coming on, we'll start to see that showing up in the long end with 10-year yields actually pushing to the downside. So even though 10-year yields are also sensitive to interest rate expectations, just like the 2s, the bigger driver for the 10s is what the markets think is going to happen to inflation and growth in the medium term, which is why looking at something like the 10s and 2s spread, this one in purple, why that's so helpful, because when we see a strong inversion, i.e. the curve pushing to the downside, that usually tells us there's a negative expectation for growth and inflation in the medium term, and vice versa, when it pushes to the upside, there's more positive expectations for growth and inflation in the medium term. Obviously, there's going to be other forces which can influence the curve, so such as quantitative easing. It's important to keep in mind. Open market operations can influence how the curve responds. So we look at the overall trajectory, not necessarily the day-by-day tick movements, if that makes sense. Now, apart from that, 10s is also very commonly used as the risk-free rate when you're doing something like discounted cash flow analysis, and it's also widely used for calculating the weighted cost of capital. So that's why there's normally more attention on it. And of course, the 10-year yield, it is the benchmark used for setting most of the other interest rates. So mortgages, mortgage rate gets affected by what happens in the 10-year yields. Your credit card repayments, etc., gets affected by what happens in the 10-year. So it is used as a benchmark, and thus when that changes, it will have ripple effects in other markets as well. So in that sense, the short end, like the 2s, they are helpful in times when there's a lot of focus on short-term interest rate expectations. But keep in mind that in the post-global financial crisis world, where interest rates went down to the lower bound, there have been times when they just didn't really tell us much that we didn't already know, i.e. that rates are going to stay low for a long time. So for example, if you look at the 2-year yield year back from 2010 all the way up to 2013, they really didn't tell us anything that we didn't know. We know that rates were going to stay low for a very long time. They were basically flat, all the way from 2011 to May 2013, just before we had that taper tantrum kicking in. So based on that, in that entire time, there just wasn't a lot of focus on 2-year yields because the markets just didn't really have any expectations for rates to go anyway. And a very, very similar situation, of course, played out for the majority of the last, from March 2020 up until September or May this year. Rates didn't expect to go anywhere. So 2-year yields it's not that it wasn't important, it just wasn't in focus because the markets knew, okay, there's absolutely zero probability that rates are going to go higher. So yields stayed low in the front end, but obviously growth and inflation expectations saw a push to the upside in the back end. So notice, how the yield curve, if we go back to 2013, 14, 15, notice how the yield curve inverted from 2013, because what happened in 2013, of course, we had the taper tantrum where the Fed came out saying that, hey, we're probably going to stop buying assets at some stage, and that immediately saw massive upside in the back end of the curve. You saw a 10-year yields pushing to the upside sharply. We didn't see as strong a reaction in the twos, but what you will notice happened here is that twos continue to grind higher ever so slightly from 2013 and continue that trajectory all the way up, because rate expectations, short-term interest rate expectations, continue to climb because the market was pricing in higher rates. But what's very important here to keep in mind is that notice how that yield curve started to invert quite drastically. Because what happened here is, even though rates were expected to move higher, the reason why 10-year yields started to drop, why we saw that big inversion taking place in the yield curve, was because we started to see lots of demand for bonds at the long end, driven by medium-term growth and inflation expectations, which was both falling at that time. So, going into 2014 specifically, there was a lot of concerns building up in the markets about where the global economy was going. So we had China starting to slow really considerably. We had Europe slowing down. Most of the world started to slow down quite significantly, causing growth expectations to drop. Obviously, a first negative for yields in the long end. And apart from that, to make matters worse, especially for the long end like the 10s, you'll see that this green line here resembles WTI. You can see that massive drop we had from May all the way down to Jan 2016. That big drop in oil prices was due to a massive supply and demand imbalance, because we had demand already taking a hit because the markets anticipated slower growth, slower demand due to the global economy going through a bit of a hiccup. But at the same time, we also saw a huge oversupply, because OPEC basically came out in 2014 saying that, hey, we're not going to decrease production just to save oil prices, because that'll mean that we're going to give up some of our market share. So, why would they drop production to lose further market share against the shale industry? So they decided just to, keep production supply at high levels, and that obviously knocked oil prices down. So you had a supply and demand huge imbalance there, and expectations of a growing imbalance, causing oil prices to fall significantly. And as you know, because oil is such a key component for inflation and inflation expectations, that gave the long end an additional knock to the downside as inflation expectations started to drop as well. So there was demand for bonds in the long end, i.e. pushing 10-year yields lower due to investor confidence dropping, sending 10-year yields lower, while the short end, the short-term bonds were actually still sold, pushing 2-year yields higher because markets still expected higher short-term interest rates. So, bringing this back to where we are right now, from March 2020, when the Fed cut rates down to zero, there wasn't a lot of focus on the short end, as there was no expectations for rates to really go anywhere, right? Everybody knew that rates were going to stay low. It was only from really June, when we had that first hawkish shift from the Fed, that short-term rates came into focus, and then obviously that just accelerated with every FOMC meeting that we had, as markets really started to ramp up hike bets, obviously in line with continued rising inflation expectations as well. So here you can also once again see why for so many months there was no focus really on the short end. It was just flat, and there was a lot of focus on the long end, or the 10-year yield. That continued to push higher, of course, because the market was pricing in a much better medium-term growth and inflation expectation. Obviously, alongside rising oil prices, rising actual inflation, etc. So right now, the focus is once again on a possible inversion that we're seeing taking place, where there is expectations for rates to move up in the short end, i.e. 2-year yields is pushing to the upside. But at the same time, 10s haven't moved up as much as the 2s, as there's some question marks about medium-term growth right now. Not so much inflation, because that's still pretty high, and markets are still a little bit uncertain about where inflation is going to go. But if inflation continues to drift higher, that is going to negatively impact growth even more. So you can still see yields pushing lower on growth expectations, even while inflation still remains high. So in this sense, it's not that twos isn't important. It's always important to keep track of where twos are, but more important in relation to the message that the long end is giving us as well. So right now, policy normalization is suddenly on everybody's radar. Just a couple of months ago, nobody expected rates to go anywhere. Now, all of a sudden, every central bank, or at least most of the major central banks, are expected to hike rates in the next couple of months. So that means that yield differentials, especially in the short term, like the ones and the twos, that will carry more importance than usual right now. Not that they are ever unimportant, of course. It's just that the focus will shift more to carry in the next couple of months, which means that there will be more focus on the short term rate differentials compared to just medium term growth and inflation expectations. But again, it's also important to track what the long end of the curve is telling us with regards to medium-term growth and inflation expectations, because that will eventually impact policy expectations as well. So hope that helps with the explanation, Brian. As always, any other questions, don't hesitate to let us know.